Over the last few weeks, you may have noticed something interesting. Mortgage rates have started to come down. Not a lot, not dramatically, but enough that people are starting to ask, is something changing? And we're actually seeing more showings happening on a lot of listings that have been sitting. Today, I want to explain what's actually happening, why it's happening, and what it realistically means here in Colorado Springs if you're thinking about buying or selling. If you're new here, I'm Tulio Pena with the Pena team in Colorado Springs. We help a lot of military families, relocations, move up buyers, and some people moving down. And we spend a lot of time studying what's really happening in the market, not just the headlines. And just to be clear, this is not a hype video. It's not a prediction video. It's a let's understand what's changing and what it means for you video. First, a quick myth to clear up. Mortgage rates don't come directly from banks and they're not set by the Fed. Mortgage rates mostly follow the bond market, specifically mortgage-backed securities. Here's the simple version of how it works. When investors want to buy more of these mortgage bonds, they are bidding on the price of the bond itself, not home prices or anything like that. The price of the bond itself. The more demand there is, the higher the price the bonds get pushed to. And every bond has something called a yield. The yield is simply the return an investor gets for owning that bond. Think of it like the interest the bond pays. Here's the key relationship. When the price of the bond goes up, the yield or the return goes down. And when the yield goes down, mortgage rates tend to come down with it. So when you hear that the bond market is improving, what that usually means is that investors are willing to accept a lower return. And that shows up as lower mortgage rates for borrowers. So rates move more on investor demand and confidence than on headlines. Recently, something important happened behind the scenes. A government-level decision was made to support the mortgage market by having Fannie Mae and Freddie Mac start purchasing a very large amount of mortgage-backed securities, about $200 billion worth over time. Here's the important nuance. This wasn't a debt. This wasn't taxpayer money. This came from cash reserves that Fannie Mae and Freddie Mac already had on their balance sheets beyond what they're required to hold. That money is now being used to systematically buy mortgage bonds. That increases demand in that market. And when demand goes up, bond prices go up. And when bond prices go up, yields come down. And when yields come down, mortgage rates tend to follow. This wasn't done because inflation magically disappeared. It was done because housing had become a pressure point for the broader economy. When housing freezes, people don't move. They don't upgrade. They don't take new jobs. Builders slow down. Consumer spending slows down. The goal here is not to create a boom. The goal is to unstick the market and get normal movement going again. Here's the most important part. Markets don't turn when conditions are perfect. They turn when people believe the worst is behind them. Even getting rates into the high fives, if that happens, doesn't fix affordability overnight, but it does break the stalemate. It brings back move-up buyers. It brings back military families who've been waiting. It brings back sellers who've been stuck. And it brings back people who need to move for life reasons, not market reasons. Here's what I'm seeing every day in Colorado Springs. A lot of homeowners are sitting on 3 and 4% rates and feel trapped. A lot of buyers can afford the house, but not the payment at 7% or higher. And even a 0.75% to 1% change in rates makes a huge difference in monthly payments in the $450,000 to $600,000 range. For VA buyers and families that are PCSing especially, This is meaningful. It doesn't create a frenzy, but it does restart movement. And let me be very clear. This is not a the market is fixed moment. This is a conditions are slowly improving and confidence is starting to fall moment. So the right question isn't, should I try to time the market? The better question is, if I might need to move in the next 12 to 24 months, how do I position myself smartly as conditions improve? Strategy beats guessing. If you're thinking about buying, selling, or you're PCSing in 2026, I'm happy to help you map out a plan, even if it's a year away. You don't need perfect conditions. You just need a good plan and good information.